Hello everyone, we are from Group 4. We will present about asset valuation model and alternative profit determination. And this is our group member. So the first matter is difference in financial reporting practice. Difference in financial reporting practice are mainly due to difference in accounting standard used, such as IFRS and use GAAP. IFRS is principle and used globally, while US GAAP is more detailed and applicable in the United States. This affects how companies recognize revenue, value asset, and present financial statement. In addition, cultural factor, laws, and regulation in each country also influence this difference, making it difficult to compare financial statements internationally. And this is some difference in financial reporting practice, like basis of presentation, consolidation reporting practice, business consolidation, minority ownership, valuation of fixed asset, goodwill, inventory costing, contingency reserve policy, deferred income tax, pension disclosure, research and development costs, foreign currency translation, and long-term leases.
In determining what attributes should be used to measure elements in financial statements, it is important to choose attributes that can minimize reporting timing errors. These timing errors usually arises when a change in a value occurs in one period but is recorded in a different period. Therefore, it is better if the change in value is recognized and reported in the same period when the change actually occurs so that the financial information presented remains relevant and accurate.
Here we will talk about measuring unit errors. Measuring unit errors are errors in presenting figures in financial statements that occur due to ignoring changes in purchasing power. This error occurs when items in the financial statement are still presented in historical monetary units without adjustment for inflation rates or general price changes. The causes of measuring errors is financial statements are not stated in current purchasing power units but rather use historical figures that no longer reflect real economic values. And then, because price changes or inflation cause the real value of the money used in reporting to be inaccurate, which can mislead users of financial statement. And then the recommended measurement criteria. In order for financial statement to be free from measuring unit errors, the measurement standard or method used must consider inflation factors. In this case, the recommended criteria for measurement units are: the first, using measurement units that adjust financial statement to change in general price levels. In other words, financial statement must be set in current purchasing power units, not just nominal historical features. And then the primary objective of unit errors. The objective of avoiding measuring unit errors are to present financial information that is relevant, accurate, and not misleading, especially in economic environment experiencing inflation or deflation. And the second one, ensure that the values of assets, liabilities, income, and equity reflect economic reality, not just historical records that can mislead decision making.
Different price levels. First, a change in the general price level refers to changes in the prices of all goods and services throughout the economy. The second one, a change in the specific price level refers to a change in the price of particular product or service. And the last one, a change in the relative price level of a commodity refers to the part of the specific price change that remains after the effects of the general price level change have been eliminated.
Replacement cost. In this material, we discuss replacement cost accounting and replacement cost financial statement. So let's start with replacement cost accounting first. Replacement cost accounting is defined by several key characteristics. It uses replacement cost, the current cost, to replace an asset as the basic for valuing elements in financial statement. This method assumes a stable monetary unit, meaning it does not adjust for inflation. It also follows the realization principle, recognizing income only when it is earned and realized. Additionally, it distinguishes between operating income and holding gains or losses, as well as between realized and unrealized holding gains or losses, providing a clear view of how much profit come from actual operation versus change in asset values. So we next to replacement cost financial statement. Replacement cost financial statement have several limitations. They may include timing errors in recognizing operating profit and measuring unit errors due to the assumption of a stable monetary unit. While they can be interpreted as net operating distributable or NUD, income for the profit and loss statement, and current operating cost or COG for asset valuation. The relevance of COG measures mainly applies to asset figures, not income statement items.
Next material is alternative accounting models. Alternative accounting models are accounting approach that adjust financial statement to change in general price levels so that financial information remains relevant and accurate. There are three models. One is general price level adjusted historical cost accounting. This model combines historical cost with an adjustment for general purchasing power. Under this approach, the values in the financial statement are still based on historical cost but adjusted for inflation or the purchasing power of the prevailing currency. The four main principles used are the use of historical cost as the basis of measurement, adjustment for general purchasing power, the principle of matching, and the principle of realization. This means that the profit recognized is the difference between the realized revenue and the historical cost, both of which have been adjusted to the unit of general purchasing power. Although this model still contains timing errors, it is free from measurement and unit errors and still provides relevant interpretation, especially for monetary assets and liabilities and cash figures. Two is general price level adjusted replacement cost accounting. This model goes a step further by replacing historical cost with replacement cost, that is, the current replacement cost of the asset, which is then adjusted to general purchasing power. The five essential elements of this approach include the use of replacement cost, adjustment to general purchasing power, the realization principle, and the separation of operating income from realized and unrealized gain and loss. Although the financial statements in this model also contain timing error, it is free from unit of measurement error and provides an accurate picture of the cost of gold sold in the input market. This model is particularly useful in volatile economic conditions as it reflects the actual cost of replacing assets. Three is general price level adjusted net realizable value accounting. This approach uses net realizable value, the realizable value of an asset net of selling cost adjusted for general purchasing power. Unlike the previous two models, it abandons the realization principle and strictly separates operation income and realized or unrealized value gains or loss. The main advantage of this model is that there are no more time or unit or of measurement error, making it very clean model in terms of measurement. In addition, it provides the most relevant estimate of cost of goods sold based on the market value of the output, making it suitable for business that rely heavily on realized value such as trading or manufacturing by selling goods. Maybe that's all the material from Group 4. Thank you.